What I really want to talk about today is some practical examples from the demand side, and going straight back to Josephina and Manfred's request for those. And I was very pleased to hear in their presentation a desire for practical issues to be heard. And it sounds like you've got absolutely the right idea in terms of how to go about this. I guess you've done this sort of thing before. One of the things that was interesting, particularly from Josephina's talk, was the need to make sure there is a relatively easy translation between financial information and metrics through to technical ones and vice versa, and that is absolutely the case, as Pete's presentation has suggested. Anyway, in terms of the things that I'd like to speak to today, to cover some of the similar ground quickly that Peter's covered in terms of why investors, pension funds, insurance companies, etc., institutional investors typically want fund managers and building owners to report sustainability achievements, and then how reporting requirements have changed and are changing, and some practical implications. Before I start, it's fair to say that if I have a look at the communication from the Commission, and I think about my own clients, who typically are building owners, landlords, and developers, and we work with them throughout the property life cycle. So that's looking at portfolio management, asset management, which will include development and, importantly, refurbishment, again, which Josephina highlighted. Typically, they're not looking around the property life cycle themselves in terms of the environmental impact. Typically, they are looking at things like what they call green performance, by which they mean environmental performance, which very often they mean energy in use performance. So this initiative is very timely, certainly. There are some leaders in the industry, and some of them are in the room from the demand side, who are moving ahead in this area, but we need to make sure that the rest of the industry moves as quickly, at least, as they do. So, just to cover on, to come to initially to why investors want building owners to report their sustainability achievements, and Pete mentioned that there is a linkage between better buildings and better investment performance. The key question, as Pete has suggested, is, does better mean greener? And there is quite a lot of information out there in terms of linkage between the greenness of portfolios of individual assets and their value. And here we can see a slide taken from the World Green Building Council's Business Case for Green Buildings report produced last year, which took a sample of studies where buildings assets had achieved the national standard, BREEAM, LEED, etc., and mapped those against their investment performance. And there is quite a lot of noise there. You can see that the origin line is here. So in general terms, there is a positive correlation between the greenness of the asset and their value. But that is quite a wide spread. And we can only hope that Pete and his colleagues and his peers in the industry continue this research, and they are able to see some consolidation of this, so that we can see perhaps the beta becoming a little bit clearer. Another thing that Pete mentioned, which is absolutely the case, and this is something that we're beginning to see a change on in terms of performance across many jurisdictions, is, yes, there's a realization that occupiers drive investment returns, but what does this mean in terms of sustainability? Well, we can see listed down the left-hand side of this chart all sorts of benefits from investing in green buildings, and all sorts of examples and reasons as to why that might be the case. And these things have been known for some time. But what we're beginning to see in many markets is an increasing realization that landlords can and should attend to the needs of occupiers more pressingly than they have done as far as sustainability is concerned, rather than looking at individual assets from any other perspective. And we can see all sorts of evidence in the marketplace and from researchers as to why this will be the case. And so many organizations, particularly large corporates, buy into these kinds of data. Stock price performance, whether there's operational performance improvements because your business is running in a greener manner, and whether the cost of capital, as we've seen already, is coming down. And what's happening in the bond market as far as green bonds is concerned is really exciting and interesting, and I think will lead to all sorts of positive change. We've seen the likes of the Vornado bond, but also what's happening from Stockland and others around the world. It will be great to see greater movement of that in a European context as soon as possible, and there are definite moves in that direction. But when it comes to engagement between the building owner and the building occupier, in many jurisdictions it's very difficult actually to see what how influential the landlord can be as far as the occupier is concerned. And if we accept that all organizations, whatever they are, even the smallest app developer, right through to the largest corporate, they all have buildings, they all have real estate. Now, to most of those organizations, buildings actually are often represented as a bit of a problem. They provide the accommodation in which we undertake our activities, our businesses, and in that respect, that's all they do. But actually, as an investor, as a fund manager, as a REIT, owning those assets, we need carefully to think about how the provision of space actually will lead to better performance. Now, this is where I think we might see a bit of a change in pace and focus as far as this sector is concerned, and particularly for landlords and their investors to see a greater need to attend to the whole life cycle of the asset. Because I said at the beginning, typically many landlords, building owners, will see that they can only do what they can do as far as an asset is concerned, because they've bought typically an existing asset, and they can maybe make some changes to that through refurbishment, but they need carefully to be thinking about what occupiers require. And we can see some evidence again here from the World Green Building Council report from last year, and also from one published in September of this year, which links the greenness of buildings with occupier performance. Now, this to building owners should be, and for leading building owners already is, absolute gold dust. Because this is where investment with the occupier is where the investment return is really generated, as we've already heard. And this is where, therefore, those building owners who want to achieve competitive advantage will increasingly focus. What can they do to make the building occupier more productive? And given the evidence that there is in the marketplace between the greenness of assets and better productivity, this is where organizations will improve. We work with many occupiers. In an office building, typically the occupational cost is made up of more than 90% is the labor cost within the building of the total occupancy cost. Energy, for example, may be 1%. So if you go to the chief financial officer of that organization and say, I'm going to, through green refurbishment, I'm going to give you what you need in your building, actually what you need to be doing is having a conversation about the productivity of people, as well as the reduction, say, in energy cost. But to the CFO with their cold heart, and I work for a firm of accountants, so I can say this, the CFO is much more interested in leveraging from the 90%. So how do investors participate in this? And we've heard a bit about some specialist funds, and yes, there are green funds that organizations, investors do invest in, but much more, I think, pertinent really is actually investing in the existing fund managers and REITs, rather than setting up and establishing new green funds. Many of these organizations, some of these organizations represented here, this comes from an organization called the Better Buildings Partnership, which is doing a lot to advance thinking in this area. So, how have reporting requirements changed, and how might they? Well, in many cases, of course, this was driven by regulatory change. And here we can see, just from one member state, happens to be the UK, that regulations have come pretty thick and fast over the last few years, and we see lots more coming in that regard. And this is something which has motivated building owners in the recent past and continues to do so. But if we also have a look, we were recently engaged by the UK property industry to have a look at penalties and incentives relevant to non-domestic properties in the UK, just to see where they fall across the property life cycle, which is represented here. You can see all sorts of things. And now the response from the marketplace was, well, it's fine having penalties and incentives, and actually the market likes to have regulation, it likes to have certainty, it likes to know where it's going, and it likes to have a signpost as to where that might be in future, so long as it's reasonable. But actually this represents a very confusing situation in the marketplace, so perhaps there needs to be some reference to this. Interestingly, there's not that much at this end, if you like, of the life cycle, and there's a lot on the in-use end. And this is typically why investors focus on the in-use side rather than on the earlier parts of the life cycle. There has, of course, also been a growth in measurement and reporting, and here's just a sample of some of the benchmark systems, for example, that exist out there. It's a pretty confusing maze for many organizations to choose. Some of them are requirements because they're required by regulation. Some of them are voluntary. So which do you choose? That presents perhaps a bit of a problem. But then we've seen certain benchmarking systems come out which have become very, very popular. And here is a slide you've already seen before, or referenced to a similar one from GRESB, which Peter's referred to. And we can just see here just some of the information. Pippa, this is like an advert for you. This is an indication of how the use of the GRESB benchmark has grown. And that has grown because investors are requiring fund managers, REITs, private investors to be much more transparent about what they're doing. Some practical implications about this right now. So just coming towards the end, James. So this proliferation of measurement and reporting is a problem. It's a real problem. It's a problem for organizations to know which they should, which benchmarking system they should get involved in. When I was asked to get involved in this activity, in this process, my first and very brief response was for my heart to sink and think, oh no, another one. How is the industry going to bear another benchmarking system? I'm pleased to say I'm being won over. Because I think it's all about simplifying the process amongst many of its benefits, which we'll explore later on. But you can see here from Paul McNamara from the Institutional Investor Group on Climate Change, refers to this proliferation as baffling for most organizations. How do they deal with it? And so seeing which of the different benchmarking systems you might get involved in is really difficult. And we can see, we've had reference to things like LEED and BREEAM, and there are other ones from different jurisdictions which occur. And there are ones which are relevant to the construction, to the operation of buildings, and others which are about portfolio benchmarking and management. Most fund managers are confused by this, believe me. And if we don't engage with them carefully about understanding the full life cycle and the need for some kind of carefully thought through and simple benchmarking system, they will run away from it. And lastly, I'm just going to come to some other things. What about misleading reporting? And here is an example, again, from the UK, and I know it's pertinent in other jurisdictions to an extent as well. This is called the performance gap, and this is again from colleagues at BBP and our friends at JLL, who have noted that an E-rated building, so towards the bottom end of the energy performance certificate, performs better in terms of energy use than a B-rated asset. And that's because of technical issues relating to the certification scheme. This is common in the UK and in other jurisdictions. We need to avoid having this kind of crazy situation where we have poorly certified buildings. But a lot of investors and other people in the marketplace come to me and ask us to do this kind of risk assessment. And this is what's really beginning to shift the dial in practical terms. How does a certification scheme actually hit the top line and the bottom line as far as their organization's portfolio is concerned? So we have some regulation coming up in the UK, 2018. You won't be able to market or let properties which fall in the bottom 2 brackets of the energy performance certificate, which means that for these funds, anonymised, that around here, you're starting to see some real risk. I sat with a group of fund managers about this, and I started to talk about sustainability. Out come the blackberries, not very interested. I start to talk about beta. I start to talk about risk. I start to talk about them not having bonuses next year because their fund is going to perform badly, and this blackberries go away. Give us some advice about what we need to do. But it's not just about this. What it's increasingly about is that occupier issue. What is driving investors is a need to provide buildings through development, through refurbishment, and therefore to have a better understanding of the life cycle. What is going to help occupiers to be more productive in their buildings, whether that's offices, whether that's retail, having better sales per square meter, whether that's industrial, leisure, or whatever. And that will be what really shifts the market and what really shifts the thinking of building owners. Thank you.